take that as a so I'm going to be giving you, I actually structured my presentation less as a presentation, more as kind of an educational thing. So what I'm going to suggest to all of you, I'm going to talk pretty fast because I actually have a lot of material. I don't want them to have to cut me off at the end. I'm going to suggest that you take some good notes, right? All right. So my presentation, your guide to escaping the pitfalls of trading, leveraging options premium selling. That's really my claim to fame, is options premium selling. And here's some facts, right? A lot of uncertainty with what is happening in the world right now, but what's happening in the markets, if you play it right, it can set you up for months, if not years to come, right? Because money, you got to remember this, money is not created or destroyed in the markets. So despite, what the talking heads are saying, when, the market goes down a day and they're like, oh, so many billions of dollars, just trillions of dollars just left the market. It actually is just moving from one person's hand to another, right? So the key is making sure you put yourself on the correct side of the transaction, right? If people are buying and they're raising the price of something, you should be selling. If people are selling and lowering the price, you should be buying, right? You got to put yourself where you're going to be making the profit. Now, I just wanted to throw this in here, and this has, well, I'll just read it first. This is my mentor, and my mentor, I learned how to do a lot of this options trading back in the middle to late 90s, right? And so my mentor is still around, although he's also now pushing 90 himself. But he posted this on Facebook. He's like, I just hate to be the guy to break this to you, but most of the self-described experts out there have their heads, I'm not going to say what firmly up their arse, right? There are shortcuts to success, but none involve magic. So shame on you if you get involved in some scheme that sounds too good to be true. That's why I like partnering with Cyber Trading University and Fausto on these events, because I've known Fausto for, gosh, 15 plus years now, and I know how he scrutinizes who's going to be on these events. But beware, right? There's a lot of stuff out there, especially in trading the markets, that it's too good to be true. So, first of all, there's a lot of emotions that can happen no matter what you're trading, Forex, options, crypto. To stay disciplined, make sure, write this down, plan your trade. Always do this, right? Plan your trade, trade your plan. I know that sounds like review, but so many people, it's simple, but not easy, right? A lot of people that I look over their shoulder, some of them don't even plan at all, but many of them, when they do plan, they wind up, not trading their plan at all anyway. So keep that in mind, right? And when you have a plan, make sure you keep it simple and concise, right? I always, when I'm, putting together my plans, whether they are like I used to when I first started on 3x5 cards, or now they're all electronic in the form of Slack messages, but whatever, it doesn't matter the medium. I make sure that it's simple enough that a 10-year-old or a fourth grader can execute it, right? I don't want to be in the heat of the moment and be looking at my plan and not being able to make sense of it. So keep that in mind when you're crafting your trade plans, and back test your plans on similar patterns. In fact, I also tell my program participants to forward test their plans. That means, basically paper trading, but the difference is with forward testing is you're actually, in real time on, potentially similar patterns, seeing how your plan would work. Don't forget as well, because a lot of people forget this, risk management is the number one thing when you, again, doesn't matter what you're trading or what, you're investing in, knowing your max loss. A lot of folks, again, looking over the shoulder of many investors, many traders, they don't pay attention to what is their potential loss. So make sure risk management's at the top of your list. Then, of course, being able to recognize patterns, that's probably second. Third is what sort of trading strategy are you going to apply to those patterns? And finally, the timing, right? So those are the four things. And that's actually in the order that, at least with my type of trading, uh, that's the order of importance. Risk management, number one, being able to recognize patterns, then being able to, find the tool in your toolbox with your trading strategies to, utilize that pattern for profits, and then ultimately timing. So before I go any further, I want to make sure I'm clear. What would be ideal for you with this presentation? Are you somebody who's at this multi-speaker event learning how to invest, and your goal is to be able to do it all by yourself? That's option A. Learn how to fish and be 100% self-reliant. Number two would be learn how to invest, but also have seasoned investors around you reviewing your investments before you make them. Maybe it's C. Maybe you're not into really like wrapping your head around this stuff at all. What you want to do is just be around those seasoned investors and kind of, do what they're doing. Or maybe you're here for some other reason. Let me know. Okay, I'm getting some of the answers in. And all right, it's a little bit all over the board, mostly A's and B's. So I'm going to structure my training a little bit. I'll skip some stuff just so I can. So let's focus on this. If you earn 6% on your money every month, your investment is more than going to double every year. Now, how do I know? Well, first of all, you guys probably have all seen that whole penny thing where, hey, would you rather take $50,000 right now, or would you rather take a penny that doubles every year or every day for a month, right? And you know that in the beginning, you're like, a penny. Maybe I should take the $50,000 and run. But by the end of the month, that penny is up, if it's 31 days, 32 days, it's up over $10 million. So the penny is the answer. But what that doesn't really tell you is that you've got to be in the game for the month, and you have to be taking action, right? You have to be making sure that penny doubles. And that's where in lies the rub, right? Because in the beginning, when you're watching that penny double, it's like 2 cents, 4 cents, 8 cents. It's not really worth the amount of effort, at least if you're, instant gratification oriented, which most of us are. I know I am, right? And you literally have to stick with it for days and days and days before, you're almost towards the end of the month before it really culminates. And with all the shiny objects out there being presented in front of new investors, a lot of times, before you even let what you've learned start to work, you're already on to the next, best, greatest thing or hottest topic. I mean, I've seen things come and go. I mean, Forex is still a big thing, but there was a point 15 years ago where everybody was talking Forex. Before that, binary options, right? And, then crypto came along, all of this stuff. And I'm not saying any one of those is bad or good. I'm just saying pick one that works with your lifestyle, right? And then master it and stick with it, because they all work, right? There's all experts in it. You just got to figure out what works for you. Now, what I did was I realized that, you're not going to really be doubling your portfolio every day. You may, on a good day, right, be able to double your trades and good stuff like that. But for the most part, that ain't going to happen. In fact, if you can double your portfolio every year, that's a big deal. And that's where I started from. I'm like, well, I want to double my portfolio every year. And so what I did is I realized that even with simple interest, not even cumulative interest, if I just focus on that 6% number that I'm going to get to. Now, the truth is with the trading strategies and following along with my program participants, we're actually, making more like 10 or 11% every month, which means we're actually doubling our portfolios every 5 or 6 months. But, you aim for the moon and then maybe you'll get to the stars. So you focus on this. You start with $1,000 in your trading account, which a lot of our option traders, that's about where they start. Then in the first year, it's grown, right? It's $2,012. Second year, it's about $4,000, right? In 5 years, you're just under $33,000. And in 10 years, you're a bona fide millionaire. And it just starts to go up from there. And so now you want to know about a trading strategy or trading strategies where, you could put up most of your portfolio, not have to like babysit it and get these type of returns. In fact, let me just put it out there. Right now, being a millionaire, I mean, when I was a kid in the 1970s, being a millionaire, I mean, you'd watch Chips or you watch the Dukes of Hazzard and $1 million. That was always what the criminal had stolen, right? Charlie's Angels. Oh my God, they took $1 million. But nowadays, everybody's a millionaire. The key is you want to grow yourself to a $10 million or more portfolio. So you're going to, focus on that a little bit more. All right. The thing I really like is that if you can grow your portfolio to a critical mass, right? Like $100,000 portfolio, and you use these type of strategies, you're going to generate more than $100,000 a year. Now, right now, the median income in the US is $87,000. Now, I know if you're on the left or the right coast, you're making a lot more than that, but overall, that is the median income. So, if you could figure out your expenses, grow your portfolio to a certain amount, what I don't want you to do is quit your job and expect, that there's a no money down way to generate a bunch of money, even with options, even with day trading, even with, whatever it is, you need to have money to start. So if it's possible, you do this in parallel. And so for me, when I was looking for trading in the late 90s, I was working for Hewlett Packard. I needed something that was end of day because I was pretty busy at Hewlett Packard during the day. I needed to be able to do most of my trading end of day. So that's what I focus on is, doing and now, I haven't had a job since 2005. I hit my critical mass actually well before 2005. I just kept going with Hewlett Packard until 2005. I haven't had a job since 2005. Now that I'm in my early 50s, I don't know what I was thinking, but I now have a toddler. And so I spend most of my day with my toddler. And then once my toddler's in bed and I've had a time to kind of relax with my wife, I then at around 10 o'clock at night sit down in front of my computer and figure out, what I'm going to do for the next day. So end of day trading is really where I first started because of my day job, but now just because I love freaking life, right? And I don't want to spend time out of my day in front of the computer. I rather program my automatic traders the night before and let them go. So the scoop is grow your portfolio to a critical mass without taking money out of it. And then once it's there, then you can start living off of it, right? So what am I talking about today? I'm talking about selling theta decay optimized option premium. Now that's a lot of freaking word salad, right? What I'm really saying is I'm profiting on time passing by. A lot of people think of options as instruments to leverage stock movements, right? And that is one way they work. But there's other things that influence the option price, like changes in implied volatility is a big one. And another one is just time passing by. You might have heard that options are wasting assets. And I focus on that one because guess what? Time passes by. I know every time I look in the mirror that time has passed by when I see the number of wrinkles on my face. So you can't stop that. And that's a very reliable profit mechanism on options. So before I go any further, I just want to make sure you guys have been paying attention. So what is it? What is the minimum returns we must make monthly on our portfolio if we want to more than double our money annually? What did I say? 0.5%, 1.5%, 5%, 6%, 10%. What do you think? Courtney's got it right. She already typed it in. John got it right. What I said was, let's focus on 6%. If you can do more, that's great. Larry got it right. If you could do more, that's great, but let's aim for 6%. Okay, so I already told you this. Now, a lot of people say, okay, you're talking option strategies now. I might just tune out because aren't those suckers risky? Well, you know that when it comes to options, well, when it comes to, let's say, for instance, equities or foreign currencies or even crypto, right? The scoop is we generally have to buy low, sell high. That's called going long. You have one strategy in your pocket, right? If in some cases you can actually short the symbol, right? That means you sell to open, buy to close. You sell to open high, buy to close low. So you make money when the investment goes down. So two strategies. But the beauty that I found early on in options was you can make money when the underlying symbol goes sideways, right? You could also make money on time passing by. In fact, you can make money on whether there's fear or confidence in the market. In fact, the mathematicians out there have said that with different option strategies, that means combining different options together and or selecting the options, because some people don't realize this, but the expiration date and the strike price of the options, how you select those changes how they behave. There's 27 different ways to profit. Imagine 27 different tools in your toolbox to profit on all the various patterns the markets throw at you, right? So that's what attracted me to the options, was the flexibility to recognize any pattern out there and then dig into my toolbox and not just have one or two strategies to profit on them. So I actually think it's the opposite of risky. I think it actually gives us a way to ultimately hedge against risks, right? So then a lot of people say, okay, you piqued my instruments. You've piqued my interest. What is an option? Well, the nerds out there will tell you it's a financial instrument called a derivative. What I'll tell you is these things are typically bought and sold to hedge risk. And the ones I work on, the equity options are against stocks, indexes, and ETFs, right? But what I'm doing, rather than following the masses there, is I'm actually selling them to gather their premiums, because I like to start kind of an income generating way with them. So first, let me also tell you, so again, in case my training is cut off, if you ever want to check some stuff out, if you want to reach out to us, just jot that down. I didn't give this to the CTU guys, this link, but this is just, I accumulate some links out there where you can get, some stuff from me, free indicators, any sort of beta tools that we're working on. If you want to follow us on the socials, it's called links.tt. That's the name of my company, Trading Trainer. Links.tt4.me. Oh, cool. I just noticed in the chat that the CTU guys threw that in there. So if you want to check that out, go for it, right? And I'm not gonna go through this too much, because you guys, you already know who I am. I AJ Brown, right? I founded Trading Trainer. They already put all this into the opening. If you go to any successful option trader, in the last, I'd say 20, 25 years, I guarantee a lot of them have this home study course I put out back in 2008 on their bookshelf. And I want you to realize that I'm a learner just like you. I've got a couple of engineering degrees that I actually never really used. When I worked at Hewlett Packard, I was actually, in their marketing, their product marketing division. I know how to talk to engineers, which they speak their own language, but I've never actually done it ever since leaving and getting my master's degree in automatic controls. I've got also a very strong background in commercial business and investing. And in the last 17 years, I really have focused on how to be a good teacher. And I'm a practitioner of this thing called accelerated learning methods. It's a way to get folks like me that are older, that have to learn different than, young kids. It's a way to get us to remember stuff. So that's kind of a little bit about me. In the 90s, I spent $27,000 on seminars that first year. And back then, you didn't tune in online. I mean, they had WebEx, but man, nobody was really using. You had to go to a hotel on a Saturday. You spent a half day on a hotel. Maybe some of you remember this. And then somehow you'd wind up spending like $400 and you'd come back for all day Sunday. And the next thing you know, you were on a plane going to some, 4 or 5 day intensive training. I spent, that was actually more than my undergrad degree cost. And then the crux of it is I followed a lot of these programs, or I thought I was, and I wound up giving $85,000 back to the markets that first year. That was more than all of my degrees, including my master degree. Cost. The key here, this is the code. You might want to take notes here. Number one, I had to learn to stop chasing shiny objects, settle on one type of investing, and just learn it well, right? And then here's the key. Find a mentor, right, who is currently doing what you want to be doing. And this is the most important part. And I'm telling you from my trial and error, they know how to teach, right? Because I have hired so many folks that are so good at trading options in so many different ways. And man, they could not convey what they knew to me. They were good at their own thing, but man, they couldn't teach me how to do it. This is called, by the way, in the education world, learning by guided discovery instead of trial and error. Trial and error took me 7 years to kind of figure things out. It wasn't until about 2003, 2004 that things started to make sense for me after, getting into investing in the late 90s, right? Now, my program participants are picking it up literally in weeks. Then I want you to make sure you join an investment group, right? At HP, I learned something really clear. Like Canon or Epson would release a new printer. You know what we would do it at HP? We would buy that printer. We would take it all apart, figure out how it worked, figured out any new features or benefits that they, put into the design. And then we would increment and do one thing better and release our new printer, right? In other words, I don't want you to think that joining an investment group, you still have to do everything on your own. The point is I want you to look over other people's shoulders, and I want you to let them look over your shoulder. And I call it not cheating, leveraging with pride. If somebody's doing, got an investment going that's good, you should do it too, right? And last but not least, I want you to surround yourself with like-minded investors, right? That's one thing I did wrong. My family was not really interested in trading the markets. My family was rather risk adverse. And every time I had a losing trade, they'd tell me that I'm crazy. Now, they never did make it big, and my portfolio is well over 8 figures now. So, but just make sure you surround yourself with somebody who's going to, with like-minded investors that be like, yeah, a bad day. And also who will celebrate your wins with you, right? Those are the 4 things I learned in order to crack the code. All right. Last thing I want you to know about me, then we'll get back to the subject at hand. I have a foundation that I started. I take inner city kids. I started this back in 2003, right? With 9 kids. There they are. This was an old picture back in Denver. It was actually Aurora, kind of a rougher suburb of Denver. And I'll tell you, all of those kids, I gave each one of them 2,000 of my own dollars, and each one of those kids paid me back. In fact, one of them's a finance professor at a community college in Denver. And they all went off. We actually learned how to do our trading at the library. None of them had computers to trade on. And the library limited us to 30 minutes of internet time a day. So if I could teach these kids, and every year we've been teaching more, and I have moved my foundation from the Denver area to the Chicago area. We're working with Southside Chicago kids. And so that's kind of cool. I just wanted you to know about my foundation. That's where all the profits of my for-profit trading trainer school actually goes to keep bringing this education to the kids. Last year, after taking a little pause because of the pandemic, last year we graduated 107 kids. All right, back to premium. How do we sell this stuff? 4 simple transactions. Ready? Covered calls, covered puts. And by the way, today I'm going to be talking a lot about covered calls and bull call diagonal debit spreads, but you would behoove yourself to write down writing covered puts and go either you're going to, figure it out from one of us at this multi-speaker event, or you're going to go do some research on, the Google machine yourself. But for what's coming up in the 2025, 2026 at a minimum, you need to know how to write covered puts, in my humble opinion. So go, put it on your to-do list to learn how to flip the covered call upside down. Also, write covered calls against leaps, bull call diagonal debit spread, and the corollary to writing covered puts is the bear put diagonal debit spread. That's how the academicians call it. I call it supercharging the covered put writing and supercharging the covered call writing. And now that you've got those 4 written down, I want you to put like an asterisk against writing covered calls against leaps, and writing covered puts against leaps. Those all require a cash account. And depending on where you're at and who your broker is, those can actually all be done in a retirement account, right? Tax-free, tax-deferred. Hopefully you're doing tax-free Roth, right? This guy over here, because of the initial covering position, you need to have a margin account. In order to write a covered put, you start off by shorting an underlying symbol, right? So you need a margin account. What's nice though, and let me see if I can figure out how to draw on the screen. I think I can do it just with this thing right here. Yeah. These two are related and these two are related. So if you still have a cash account and you want to be able to take advantage of the patterns that are for covered puts, most of the time you can substitute and do this guy with a cash account. So again, kind of giving some advanced topics here. Just wanted to make sure you're on the same page with me. All right. So let's talk about option premium. I keep throwing this money around. First of all, realize when you look up an option price on the big board and you see it going up and down, it's really composed of 2 components, something I call the in-the-money value and something I call the premium value. Now, again, if you talk to the academicians, the nerds out there, they won't call it in the money. They'll call it intrinsic value. And they won't call it premium value. They'll call it extrinsic value. Sometimes you'll hear the premium value called time value. That actually irks me because there's a lot more going on in that premium value than just time. So you'll never hear me. Yeah, you might. Sometimes I slip. But in the most part, you'll see that I talk about the in-the-money value and the premium value. Now, here's where I want to start with this whole, how we sell premium, right? I looked up yesterday, end of day, Oscar Health. Oscar Health is a company out there who's kind of, realizing that there's a niche for getting personal health care rather than going through insurance and primary care. And they think that's broken. And so Oscar Health's in a few states and they're expanding all the time. Anyway, Oscar Health closed at $16.25 a share yesterday. So if I bought some Oscar Health, right, and then immediately sold the Oscar March 21. So this is going to expire on the 3rd Friday of March. And the strike price is $17. If I immediately sold that, I'd get 75 cents back. Let me see if I can, by the way, clear all the chicken scratch that I put on the screen. Clear all drawings. There we go. So here's the scoop. If I did this, first of all, by getting that 75 cents back, that would act as kind of a discount on that stock, right? I'd be able to basically put out less money on buying a share of that stock. So it acts as kind of a discount on the underlying security. But realize it expires on March 21st. So the minute I sell that, it's got a timer, right? And it's losing value. And ultimately, on March 21st, the premium component of that option, and this is an out of the money option, that premium component of that option is going to be 0, right? That means I get to keep all the, so it acts as kind of a coupon. I've sold a coupon and nobody ever uses it. The other thing is I even though it's not officially a dividend, like a company dividend, options are sold in lots of 100, right? 100 shares. They're called contracts. So every contract I sell in this case, I'm going to make 75 bucks, right? All right, let's keep going. Now, 3 things are going to happen. What happens if Oscar Health closes above $17 on March 21st? Well, first of all, I paid $16.25 a share. If I get exercised at $17, I'm going to get $17 back if it gets exercised. Plus, I get to keep that 75 cents I collected per share in the first place. So that's $1.50 in total profit so far, right? 75 cents on getting exercised and 75 cents by selling that premium, $1.50. That's 9.7%. Remember, our number is 6% that we're looking for, right? So that's good. But now, what if it goes sideways? What if Oscar Health goes sideways? In fact, this is my ideal situation. I would rather it go sideways because, again, I bought it for $16.25 a share. I get my 75 cents per share back. I get to keep that 75 cents because it expires worthless. I've made 4.8% ROI so far. And then because I get to keep the stock, I get to do it again next month. In fact, monthly options expire every 3rd Friday of the month. So every 3rd Friday of the month is payday for me, right? So I like to do it again and again and again, basically renting out my stock. Now, what about if Oscar Health drops by March 21st? Well, first of all, I'm going to, in a few minutes, show you how you can reduce the risk on return even further. But I want to show you inherent in this strategy is that because we collected 75 cents up front, we've reduced our break-even price. We've basically created a profit buffer, meaning the stock would have to go all the way down below $15.50 before we were trading in the red. So inherent in this strategy, we create a profit buffer as well as the instant dividend, as well as the expiring coupon scenario, as well as the discount on the underlying security. So, well, I just gave you the answers. I'd like you to answer all that applies. What does investing by selling premium create? Does it create an instant dividend, a discount on a security, a profit buffer? Does it act like an expiring coupon? Now, I notice I said answer all that applies, and I kind of gave you the answer ahead of time. It's all of them, right? And I like all these aspects of selling premium. Now, before I go any further, I would be remiss to not show you some real trades. This is one, and I want you to pay attention here because I want you to look at the fact that you don't need to have a lot of stocks to do this on. Notice I started this trade on Ford back in January, not of 2025, 2024. And the first month I collected 23 cents. The next month I collected 80 cents, 35 cents, 45 cents. So basically every month I'm just renting out my Ford stock by selling the call against it. Ultimately, I got exercised out last July. But what did I do? And by the way, from Ford, from January to July, I walked away with 30, it depends on, again, the accounting method, about 30%, right? What did I do? In August, I reopened it because Ford's a great stock to sell premium on. And I took my gains from the first time around and just rolled them in. The first time around, I was doing 900 shares. Now I'm doing 1,000 shares, right? I bought Ford stock and again, did it all the way up through January. Just notice the amount of time. See, I'm not out there looking for the next best stock to trade. All I'm doing is once a month, I'm doing a single transaction. I'm selling premium and I'm just collecting it. This time, I walked away with another 12% for the few months that I was in it, right? So not bad for a basic covered call writing strategy. That was a real trade. A lot of my program participants did. So now I'm going to start asking you questions. They're going to get harder here. So if you kind of dozed off a little bit there for the first part of my presentation, let's ramp this up. How can we make this a cheaper investment, lower our investment, and increase our returns, and in some cases, even convert what would need to be a margin trade into a crash trade? What should we do? Should we A, sell out in time options, B, replace the security with options trading at parity, maybe C, give up and buy mutual funds, or D, what you're talking about isn't even possible? What do you guys think? All right. If you came up with replacing the security with options trading at parity, you're on the right track. Now, a lot of people might have been thinking sell out in time options. I saw some of those answers coming through the chat. You don't want to go further out than about 3 to 5 weeks. Put that in your notes, right? Because then the obligation you take on and the amount of time you're in the option doesn't pay for itself in the theta decay, right? In other words, options get the most bang for their buck when it comes to selling premium that's optimized for time passing by when they're about 3 to 5 weeks to expiration. So selling farther out in time, that's not what we want to do. What we want to do is replace the security with an option trading at parity. So now you're saying, well, what the heck is an option trading at parity? It's the most premium, right? That premium component. It's the most when the option is at the money. But when we go very deep in the money, the option has very little premium, and we actually target less than 5%, and it's almost completely in the money value. Now, again, gosh, that's a lot of word salad. Let me summarize it. We go deep in the money and we'll get an option that behaves like the stock or the ETF or the index, right? It's going to move dollar for dollar. So if the stock goes up $1, this substitute option will go up $1, right? But the substitute option is going to be at a much cheaper price. And now you're saying to yourself, okay, I'm going to substitute a stock with an option, but this option has an expiration date. How far out should we go? Well, we want to go far enough out in time so that we can not interfere with selling many cycles of that premium. You saw here, I sold what? 1, 2, 3, 4. The previous month, 1, 2, 3, 4, 5 months, right? If I kind of foreshadow here, 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. In fact, on average, our positions last about 5 months, but it's a pretty flat bell curve. Some of them last 2 months, some of them last 8 months, right? 8 months is kind of the extreme. I've had some that have lasted longer than 8 months, but I can count them on my fingers and toes. And I've been doing this now for just under, 30 years. So the magic number is, let's go at least 8 months out. And realize, you can go 8 months out, but if you go a little bit further out to the next leap, leaps are options that expire in January, you'll have more liquidity, more of a market. So we typically use the leaps, not always, right? Sometimes we can find enough liquidity, like in this case, in the October, November options, but most times we'll go out to, in our case, January 2026. So remember that Oscar Health example? I used end of day prices from yesterday. I could buy Oscar Health, or I could buy the Oscar Health $5 call for cheaper, and that's my substitute option. In this case, this Oscar January 2026 $5 call It's got 3% extrinsic value. In other words, it's going to move pretty much dollar for dollar, and I'm getting it for about 2/3 the price. So I buy my Oscar substitute option. I still sell the same, at the money option that expires March 21. I get my instant dividend to $75. So the big question is, what happens if Oscar Health goes up? Well, I'm going to get exercise. Now, I'm going to get exercise for the difference between the two strike prices. So the $5 substitute option strike price and the $17 front month option, I'm going to get $12. So you can see here, and my numbers are getting cut off here. My presentation has some numbers cutting off, but you can see here that I made over 30 cents per share profit plus the 75 cents. There's $1.05 in total profit. That's 9.6% ROI, right? Just by doing these trades one right after each other. But now what if Oscar Health goes sideways? Okay, so we buy it at a discount for $11.70. We keep the 75 cents, and we have made 6.8% ROI so far. We're going to do it again and again and again, right? This is what I like. I like collecting the premiums and not getting exercised for as long as possible. And 6.8%, remember, our goal is 6% or more. That fits the bill. Now, what happens if it drops? Well, just like in the covered call strategy, this bull call diagonal debit spread strategy has a profit buffer built in, right? We reduce our break-even price. Now, I am going to show you, like I told you earlier, I'm going to show you how we reduce our risk, our risk on return even further. But just know, inherent in these strategies is this profit buffer. All right, so I have a second. I want to show you my AT&T. Very similar to what I did with Ford, except instead of using the stock, I bought a substitute option. This one I actually started all the way back in November 2023. And then once a month, I sold premium, sold premium, sold premium, sold premium, got exercised. And then what did I do in June? I waited because AT&T had a couple of, but I waited for the perfect opportunity. And I got back in September. In fact, I'll be honest, I've been trading the same 20 to 30 underlying symbols, God, for however long, 20 years. I just am able to take the same symbols. They're boring stocks. You're not going to find them on the high flyer list. In fact, we like stocks that aren't in the news, right? Because we just want them to be going sideways, and we just want to sell premium on them every month, creating that income. Look at this. The first time around, I walked away with 56% on my buy. The second time around, I almost doubled my money just in the 1, 2, 3, 4, 5, 92.7% ROI. There's something to substituting the stock with an option, or the underlying symbol, the ETF. All right. You get the picture. Now, let's talk about one of the most important parts, and then we'll sum up my presentation. How can we drastically reduce our return on risk? Should we sell half as much option premium? Should we go farther out in time with the options we're selling? Should we collar the investment by marrying a protective option, or is what we're talking about not even possible? What do you think? If you're saying collar the investment by marrying a protective option, I see a lot of you said that. You're absolutely right. Let me show you actually a trade where this is just class. This is one of those ones that did last past 8 months, but I just want to show you some highlights out of it, right? So I bought 600 shares of this stock, and then I sold the premium, And immediately, the same day that I sold the premium, I bought myself a protective put option, right? So let's do the math here. 34.73. Then I made $1.76, and then I went ahead and spent $4.75. Now time went by. I got to the third Friday of the month. That $1.76 wound up expiring worthless, so I got to keep that whole amount. And then I didn't need the insurance anymore. I didn't need the protective option. The protective option works perfect when you have that obligation, that premium selling obligation. But once you're out of it, you can roll that protective option out to the next one. And in rolling it out, I sold for $4.75. I sold it for $5.90. So check it out. Not only do I get, in this case, it was about 24 days worth of insurance to make sure that if this thing went against me, it wouldn't blow out my portfolio. But now, because of my strategic timing, a lot of times when you talk about hedging your trades, that usually costs people money, when you buy that insurance. But because we're selecting the option 3 to 6 months, we're picking the right strike price, and we're timing it right, we actually turn our collar into a moneymaker. This is like frosting on the cake. We made the $1.76, and then what did we make here? About what is that? $1.15 additional. I've turned the insurance into a whole nother trade. I do that again. $1.47, bought the insurance for $3 and a penny, sold the insurance when I didn't need it anymore for $3.62. Again, sold the premium, $1.50, bought the insurance, $1.20. In this case, the underlying symbol actually moved. So when I sold back the insurance, I actually got a little payout, $3.07. Did it again. And so you just rinse and repeat. So yes, I've added an additional trade every month. So in addition to selling the premium, on the same day, I buy protection. And then once the premium's gone, I sell the protection. So now there's 2 transactions a month instead of 1. And on the day that I sell the premium, I also buy the protection. But it gives you so much peace of mind. Here's the other thing. Notice this column here where it talks about the break-even price. Notice that when I sold my protection back just that first month, my break-even price after I collected this premium, it dropped all the way to $31.86. Now, I want you to notice when I sell my protection, it's at the $34 strike price. So what does that mean? What does it mean to have your protection protecting you more than what your break-even price is? Think about that a second. This is that trade, by the way. Here's that break-even price. Now, I want you to know, first of all, I want you to notice that the profits don't accrue linearly. They accrue parabolically. That's that compounding. So the longer I can leave my symbol in place and just continually sell premium against it every month, the more that the profits go exponential on me. And now there's the range low and the range high. That means either getting exercised or getting risked out, getting stopped out. And what's beauty is I'm profiting on time passing by. A lot of people come to me and say, AJ, they're not sure they really can wrap their heads around holding a position and having it profit based on the amount of time you hold it. Instead, they're like, what's your win-loss ratio? Well, the beautiful part is if the underlying symbol goes against me, I still work out with money, right? If it goes for me in 5 months, I've made 65%. If the underlying symbol goes against me, I still make 50%, right? That's the beauty. I don't care whether the underlying symbol is a win or a loss because I just care, within 1 month, my overall position is risk-free. Do you guys get that? I just have to hold my position for a month and continue to just sell premium and roll out the insurance every month. And very quickly, it's a risk-free position. And it's just, there's no money on the table. It's all the dealer's money. What do we have when our cost basis, our break-even price, is less than our protective bailout price? Is it a risk-free investment? Is it a losing trade? Is it too much complexity? Is 2 trades a month too complex for you? Is all of this a pipe dream? Has AJ been hitting the crack pipe? It's a risk-free investment. All right, let's review, and then let's button this up. 3 steps. You're going to buy or short an underlying security, a stock, an ETF, an index. Or even better, you're going to buy a substitute option trading at parity. And again, go research writing covered puts and doing legging into bull call diagonal debit spreads and bear put diagonal debit spreads. Step 2, you're going to sell a near term 3 to 5 weeks at the money option for its premium value. You're going to collect an instant dividend and create that profit buffer. And finally, you're going to collar with a married option that's 3 to 6 months out in expiration to protect your investment. And then you're going to rinse and repeat steps 2 and 3 every month. And you'll notice on all my trades that I leg into the positions. That means I do each one. I look for these sideways stocks like Oscar Health. If you pull up that ticker right now, it's one of those. I look for those sideways stocks. And if I'm at the bottom of a sideways channel, that's where I use the covered call. So I'll buy the stock or I'll buy the substitute option. I'll put a stop loss in place. Then when it peaks, I sell the call. I buy the protective option. The call expires on the 3rd Friday of the month. I sell the protective option for an additional profit, rinse and repeat. That covered put, which we didn't really talk about much today, you start at the top. You short or you buy a substitute put option. Again, put a stop loss in place to the top side. Sell the near-term put, buy a protective call. Near-term put expires worthless. Protective call, you roll out, rinse and repeat, steps 2 and 3. How would you like to never miss a pick, minimize the amount of time you spend away from your loved ones, have support whenever you need it? Because that's what we're talking about, right? We're talking about how to do this, but also save time, create clarity, and get results. So would it be okay if I take just a couple of these last minutes and tell you a little bit about my materials, my training, and my tools to see if they might be a match for you? Thank you. What I've got in my program is for someone who doesn't want to pay for multiple data subscription, wants everything they need in one place, doesn't want to miss any opportunities. They want to spend more time doing other things, and they don't want to be doing this alone. They want step-by-step instructions. Summed up, it's for somebody who wants consistent and reliable results, right? This is a testimonial about Charlene. I'm going to bypass it just so I don't, have them cut me off early. But Charlene was a great story about how she got cancer, but then survived and needed a source of income, and now she sells premium. So there's a few things part of this program, right? What's it all worth to you? We give you video tutorials. In fact, I've got my web portal. We give you members only access to this here web portal right here. And we've got all sorts of things that you access, including the video tutorials on how to get it done. We have monthly live lecture classes and all their replays. I've been running this program since 2007. We have the replays going all the way back to 2007. We also have a bunch of screeners. You might be like, how do I find the underlying stocks? We actually have 4 different screeners that run every evening to help us find the underlying symbols we should pull these strategies on. We've got planning tools, right? I talked about how important it is to trade your plan and understand your risk. We have all the planning tools that you can have and take with you. And this is what a lot of people like. The weekly live workshops. People bring their tickers every Thursday. We're having one this evening at 9 p.m. Eastern time. Right? They bring their tickers, they throw them at myself and my coach, my head coach. And we kind of help people. We call it learn by doing, right? Learn while you earn. That's even better. I just thought of that. We go through their tickers and we help them understand why it might be good or bad. We pick one, we go through it thoroughly, we plan it out. In fact, I've had people come to the end of their program and then they renew. And I'm like, why haven't you picked it up? I used to interview them. Why are you coming back? They're like, every Thursday you give us a whole trade plan in order to trade the next week. Why would I give that up? It's cheaper to be part of your program and attend your workshops than it is for me to sit down and, so very good. We also have trade review. If you want to plan your own trades, you send them in through our private messaging link and we'll review them for you and tell you whether we think you missed something or not. Invaluable. So what's all that worth to you? Because there's also a double your money back guarantee. I want you to try our program for 6 months. This is how long my, folks in my foundation do the program, is 6 months. Now, I don't think it's going to take you 6 months. I think it's going to take you about 2 to 3 weeks to pick it up. But I want you to come every Thursday, get a free trade plan, learn while you earn. I want you to be able to send, all your own trade plans to us for review. I want to look over your shoulder. So I want you to try it for 6 months. At the end of 6 months, if you're not turning a profit, not only will I give you the money that you paid for my program, I'll double it. That's how confident I am that the 6 months will be worth your while. I told you my head coach and I run the workshops. We also have coaching. I'm going to give you a free coaching session with one of our coaches. They'll help you, you tell them where you are right now, where you want to be at the end of the 6 months, and they'll help you navigate how best to get from point A to point B. So if I add in the double your money back guarantee and the bonus strategy session, now what's it all worth to you? Think about a number. Because if you go on my website, you'll see that the 6-month program is about $100 a month, $597. But because I love Cyber Trading University, Fausto, like I said, I've known him since Hammer was a hatchet. He's top notch and he puts together a good event. I'm taking $100 off for you guys. So for you guys at this event, we're tracking it. You're going to get $497. Here's how you do it. You go to optioninvesting.org/CTU, and then you have to put that promo code into the discount. In fact, what I want to do is I want to try that out just to make sure my programmers did it right. So here we go. I'm at the optioninvesting.org/CTU. And then over here, I'm going to say 100, capital D, capital I, capital S, capital C. Click apply. Yep. Dropped it to $497. So you can pay with a credit card. You can pay with PayPal. So that's how you do that. If you have any sort of problems, you can phone us. We accept orders over the phone as well, and we'll make sure we track them correctly. That's our phone number. And folks, good luck. Please pursue that covered put writing, whether you do it with us, whether you do it with somebody else, or whether you do it on your own. I think that's going to be invaluable. I hope you got a lot out of my presentation. Thank you, Fausto and team.
AJ, thanks for coming here. And that is awesome. Appreciate taking the time. And everyone just take him up on his offer. You got the QR code up there and just scan it and go from there.
Fausto, you're my hero.
AJ, it's always great to hear from you. And I got to get you back on my podcast. Let me tell you, it did great. Everyone loved it. And love to chat with you again and kind of brainstorm. But love you too, my man.
Can't wait. Talk to you soon.
Same too. Keep straight safe. All right, everyone. So before